Buying a home is still treated as the moment life officially starts. It's framed as the line between being settled and being behind, between having your finances together and still not quite there. For most people, ownership isn't a choice, it's the default. But the lived experience often contradicts the promise. Plenty of homeowners don't feel more secure after buying. They feel tighter. More monthly pressure, fewer options, and a constant sense that money is doing less than it used to. That mismatch isn't about bad decisions. It comes from how housing actually behaves financially. On the surface, it looks like an investment, but underneath it operates as a high-cost, illiquid system that quietly absorbs cash. When that system goes unexamined, the outcomes are predictable. Cash flow shrinks, flexibility disappears, and large amounts of money get locked into costs that never come back. I'm Alex. Today, we'll walk this through 9 layers, starting with the pressure that pushes people to buy and ending with the single ratio that quietly tells you when renting or owning actually works. And it starts with the story most people inherit long before they ever open a spreadsheet. The cultural pressure to buy. The pressure to buy a home rarely starts with numbers. It starts much earlier and much closer to home. It comes from family conversations, casual advice, and familiar phrases repeated so often they stop sounding like opinions. Renting is framed as temporary. Buying is framed as progress, a signal that life is moving in the right direction. Over time, that message becomes internal. Still renting at 30 doesn't just feel like a housing choice, it feels like falling behind, like missing a milestone everyone else understands. That quiet shame is powerful, and it drives behavior more than interest rates or spreadsheets ever do. So people rush the decision. They stretch debt-to-income ratios. They accept payments that dominate their monthly cash flow, because ownership feels safer than questioning the rule itself. Signing a deed feels like financial maturity, even when the margin for error disappears overnight. What makes this pressure so effective is that it's emotional, not analytical. The belief isn't presented as a strategy. It's presented as adulthood. And once housing becomes tied to identity, it becomes very hard to pause and ask a simple question. Does this decision still make sense in today's market? That question is often avoided, not because it's complicated, but because it challenges a story many people were never taught to question. Panic buying and debt stretching. Once the pressure to buy sets in, the next step happens fast. People stop asking whether they can afford a home comfortably and start asking how much they can stretch to qualify. The decision shifts from long-term stability to short-term approval. This is where panic buying shows up. Monthly payments get pushed to the edge of what a paycheck can support. Emergency buffers shrink, savings slow down or disappear entirely. The logic feels sound on the surface. If the bank approved the loan, it must be safe. If everyone else is buying, waiting must be risky. But approval is not the same as resilience. A mortgage that consumes most of your income leaves very little room for error. One unexpected repair, one job change, or one medical bill can turn a responsible purchase into constant financial stress. The irony is that the decision is framed as conservative. Buying a home is seen as stability. Yet the behavior itself is fragile. It depends on everything going right for decades. Income must remain steady. Expenses must stay predictable. Markets must cooperate. This is how people become house poor without realizing it. The property looks like progress on paper, but in daily life, it functions like a fixed obligation that limits choices. The pressure to buy doesn't create security. It often trades flexibility for anxiety. The asset illusion. Once a home is purchased, it is almost automatically labeled an asset. The word sounds reassuring. Assets are supposed to grow, protect you, and make you richer over time. But not everything that carries the label behaves the same way financially. A primary residence feels like an asset because you own it and because prices sometimes rise. What gets overlooked is how the cash actually moves. In the early years of a typical 30-year mortgage, roughly 70 to 80% of each monthly payment goes to interest, not equity. You might send $3,000 to the bank and reduce your actual debt by only a few hundred. The rest is gone. At the same time, the house generates no income. It doesn't pay dividends. It doesn't produce cash flow. It simply sits there while requiring constant payments to keep functioning. In practical terms, you're paying to use your own asset. This creates an illusion of progress. The balance feels larger because the property has a price tag, but your usable financial flexibility often shrinks. Equity grows slowly, while obligations are immediate. The result is a situation where something that looks like wealth on paper behaves like a long-term expense in real life. That gap between appearance and function is where many people start to feel confused about why owning a home doesn't make them feel financially secure. Unrecoverable costs of ownership. To understand why ownership often disappoints financially, you have to separate equity from the money that never comes back. These are the unrecoverable costs, and they are the silent drivers of the outcome. Start with mortgage interest. In the early years of a 30-year loan, roughly 70 to 80% of each payment goes straight to the bank. If the monthly payment is $3,000, only a few hundred may reduce the principal. The rest is the cost of renting money. Then come property taxes. These are not optional, and they don't decline over time. In many high tax areas, they rival the cost of a modest rent payment and tend to rise as local governments need more revenue. Maintenance is next. A common rule of thumb is 1 to 2% of the home's value every year. This isn't remodeling. It's replacing water heaters, fixing roofs, dealing with plumbing, pests, and wear that never stops. Add homeowners insurance, which has been rising rapidly in many regions, and finally transaction costs. Buying and selling can consume close to 10% of a home's value through fees, commissions, and closing costs. When you add these together, a large portion of homeownership looks mathematically identical to rent. It's money spent for housing services, not wealth creation. Why owning often mirrors renting. Once unrecoverable costs are isolated, the comparison between owning and renting looks very different. The question is no longer whether rent is wasted, but how much of homeownership spending disappears in the same way. Take a typical scenario. A home priced around $500,000 rents for roughly $2,000 a month, or $24,000 a year. On the ownership side, interest, property taxes, insurance, maintenance, and ongoing fees can easily approach or exceed that same annual amount, especially in the early years of a mortgage. In both cases, that money is gone. It doesn't build equity. It doesn't compound. It pays for shelter and nothing more. The only meaningful difference is who receives the payment. As an owner, you are effectively paying multiple landlords at once: the bank, the government, and the companies that keep the house functioning. This is why the idea that rent is uniquely wasteful doesn't hold up under scrutiny. Large portions of ownership costs behave the same way financially. They are necessary, recurring, and unrecoverable. When people say owning feels like paying rent anyway, they are often describing this exact dynamic. The structure of the costs, not the label of the housing choice, determines whether wealth is actually being built. The down payment opportunity cost. One of the most overlooked costs of buying a home is the down payment. It feels like progress because it turns into equity, but financially it comes with a heavy trade-off. To purchase a $500,000 home, a common down payment is 20%. That is $100,000 in cash. Once that money goes into the house, it becomes locked. It produces no income. It cannot be rebalanced. It cannot be used for emergencies or new opportunities without refinancing or selling. This is what's often called dead equity. The money exists on paper, but it is not working for you in any flexible way. At the same time, that same $100,000 has an alternative use. Historically, broad market investments like the S&P 500 have returned around 10% annually over long periods. At that rate, capital roughly doubles every 7 years. By choosing to lock that money into a single property, you are making a concentrated bet that one local housing market will outperform a diversified global market. Over long time spans, housing prices have barely outpaced inflation, meaning most of the perceived gains come from leverage, not underlying growth. The opportunity cost of the down payment often exceeds the benefits people expect from ownership. The rent and invest strategy. When renting is paired with disciplined investing, the financial outcome can look very different from the standard narrative. The strategy is simple in structure, even if it requires patience in practice. Instead of tying up a large down payment, that capital stays liquid and gets invested. Instead of absorbing higher monthly ownership costs, the difference between rent and owning is redirected into long-term assets. Over time, this creates two advantages at once: flexibility today and compounding for the future. Using the earlier example, that $100,000 not locked into a house can be invested in a diversified portfolio. Historically, long-term market returns have averaged around 7 to 10% annually. Meanwhile, the monthly savings from renting instead of owning continue to feed that portfolio, creating a steady flow of new capital. This approach changes the relationship with housing entirely. You are no longer relying on a single asset to grow in value. You are spreading risk across markets, industries, and geographies. Liquidity remains intact, and adjustments can be made without friction. For disciplined renters, this often leads to higher net worth with less stress. Housing becomes a service, not a financial anchor. The wealth-building engine runs quietly in the background, independent of where you live or whether prices in your local market cooperate. The concentration risk nobody admits. The biggest risk in treating a primary home as a financial cornerstone is concentration. A large share of net worth ends up tied to a single asset in a single location, exposed to a narrow set of risks. When a home is purchased with leverage, the exposure increases. Market downturns, local economic shifts, rising insurance costs, or even changes in zoning can materially affect value. Unlike diversified investments, there is no easy way to reduce that risk without selling the entire asset. Natural disasters and climate-related costs add another layer. Insurance premiums rise, coverage shrinks, and repair expenses fall entirely on the owner. These risks are localized, unpredictable, and difficult to hedge. At the same time, a primary residence produces no income. It requires constant outflows to maintain its value, while offering limited protection if conditions change. From a portfolio perspective, this creates an illiquid, high-maintenance position that dominates the balance sheet. Wealth, in contrast, is usually built through assets that pay you. Stocks, bonds, and businesses generate income and can be rebalanced as conditions evolve. A house requires payment just to exist. When housing becomes the primary investment, the portfolio becomes fragile. The risk isn't visible day to day, but it accumulates quietly, waiting for a moment when flexibility is needed most. The price-to-rent ratio. The decision to buy or rent usually comes down to one number, even though most people never calculate it. That number is the price-to-rent ratio, and it functions like a valuation metric for housing. You calculate it by taking the purchase price of a home and dividing it by the annual rent for a comparable property. If a house costs $500,000 and rents for $2,000 a month, the annual rent is $24,000. That produces a ratio a little above 20. Historically, ratios below 15 have favored buying. Ratios above 20 have favored renting. The higher the ratio climbs, the more expensive ownership becomes relative to the housing service you are actually consuming. In many major cities today, this ratio is no longer marginal. In places like Toronto, San Francisco, New York, and Sydney, price-to-rent ratios have pushed into the mid-20s, 30s, and beyond. At those levels, the cost of capital overwhelms any reasonable expectation of appreciation. When the ratio is that high, renting is not a sign of caution or delay. It is a response to valuation. You are living in a very expensive asset for a fraction of the cost it would take to own it, while someone else absorbs the financial risk. Key takeaways. The decision to rent or buy is not a test of adulthood, intelligence, or discipline. It is a valuation and structure question. When you separate emotion from arithmetic, the picture becomes clearer. Large portions of home ownership costs behave exactly like rent. Interest, taxes, maintenance, insurance, and fees are permanent outflows, not investments. In many modern markets, high price-to-rent ratios mean ownership is expensive relative to the housing service it provides. Add the opportunity cost of a locked down payment, reduced mobility, and concentration risk, and the trade-offs become harder to ignore. Renting, when combined with disciplined investing, preserves liquidity, flexibility, and diversification. It turns housing into a service and wealth into a separate system that can compound quietly over time. There is no universally correct choice, but there is a correct process. Run the numbers. Question inherited assumptions. Choose based on structure, not pressure. If this helped you see the decision more clearly, hit subscribe, tap that bell, and comment, "Run the numbers."